This is Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're discussing some of the volatility of the current time. We're recording this podcast in early March of 2020, and we're going to talk about where to go from here for investors. Our guest today is Susan Schmidt, CFA, who is head of U.S. equities at Aviva Investors. There she acts as a portfolio manager and analyst. She was formerly a senior portfolio manager focused on small and mid-cap portfolios at Westwood. Prior to this, Susan was head of U.S. equities and portfolio management at Mesirow. And in her previous life and throughout her life, she's been a banking analyst. So I'd like to start first by saying thanks for coming again.
My
Uh,
pleasure.
Susan has been here once before on a video you can watch on our website. And also to start with the impact of on the banks right now. We've had, in case anyone is looking back, we've had a substantial day. We've got 10-year bond at 0.88. We've got oil at a price that it hasn't seen in 20 years. And we have a lot of weird things going on. So could we start with the big banks and start with what you are anticipating there?
Sure. Well, it's not just the big banks here. This is the entire banking structure, I think, comes into question with the yield curve moving this low. It really does put pressure across all of the banks. And how do they make money? Because traditionally, a bank's income was made off of spread, the difference between the low, short end of the curve and higher interest rates, the back end of the curve. And right now, that's non existent. And so we look at this, and banks are the facilitator of money supply for our economy. So without them, or without them being willing to lend, what happens? This is very different than what we saw in 2008, 2009, when we had a credit issue coming
Right,
into banks, and
right,
banks were in tenuous territory. They were over levered. They had a lot of bad loans. That has completely changed. Since then, the Fed has really gone to great lengths, and the banks complained about it for a long time,
right.
to how much regulation and restriction was put on them to clean up the balance sheets. Banks are in a great position in
Yep,
terms of credit.
yep.
So this isn't about having bad credit. This is about, how do I get loan growth? What do I do if I can't make money on that spread? And big banks for now, because their capital structure is so much better than it was, can actually hold down the fort and withstand this storm. The problem is going to be, where do they show income growth? And so fee businesses become very important.
Hmm.
And I think overall, the larger investor concern is, if banks aren't making loans, then what's the facilitator to the economy? How
Right.
do we keep the economy rolling forward? And what does this mean? We are, 11 years out in our great recovery. When does that finally grind to a halt? No one in Bankland thought it was going to be credit, and it certainly hasn't been.
Right.
But we are seeing this exogenous event now with the impact of the coronavirus, concern about global slowdown. What does that do to the economies overall and the timing? And I think that's what's really shaking financial investors in particular right now.
Okay, so let's drill down into that a little bit because we talked about liquidity, et cetera. Let's start with the thing that's probably going to happen next. Is there might be a wave of refinancings because these rates are low.
Oh my gosh, and should there be? Everyone in my office is talking about it. We
Like,
have the bond guys on the fixed income desk are passing around notes every day. My mortgage guy just said I can get a 10 and 1 at this level. So everybody is calculating how much they can save on interest rates on their mortgage, and should they refinance. So unquestionably, if people haven't refinanced already, they are going to refinance now. And
mm,
even if they refinanced 2 years ago, the rates might be so compelling that it makes sense to do it now. So we are going to see a wave of refinancing. Interestingly, commentary from the big banks just a week ago was, there's so much demand right now for refinancing that the rates are not coming down as much
right,
as you would expect, because
right,
they can't handle the volume.
right.
And so there's enough competition, they can keep the rates up. So we're definitely going to see that wave, and that's great. And that is going to be very helpful for the banks. Again, fee income, we like that.
Mhm,
However, it's not an ongoing thing. We
right.
refinance, and you refinance once. It's not something that you need to do every 6 months or every year. And so you get this nice one hit, and that might be a boost to the first quarter, second quarter earnings for
Mhm,
banks this year,
mhm.
but then it's going to go away.
Right, because you can only refinance your mortgage once. And
Exactly.
so I wonder about if now we will see more of an impact from the non-banking financial institutions, the NBFIs.
I think we will. I think the non-banking financial institutions have really played an important role in this recovery. And it's a role that I'm not sure that there's a lot of clarity on how it plays out ultimately,
Right.
because we talked about credit with banks. credit at the big banks, at the publicly traded banks, is great. Banks have really been under pressure from the Fed to make sure that their balance sheets are pristine and that their loan books are appropriately balanced and they're not at risk. Somewhere that subprime loan has been
Right.
caught by someone, and it's
Right.
the non-bank financials who have stepped in there and been making all of the subprime loans. That's the area that's at risk right now, and we don't have a great window into that because there is no government oversight there. We don't see it. So we know that a lot of subprime auto loans and subprime housing loans exist, but we don't know who's holding them. Ultimately, where does that cash flow stop in the system and who gets hurt by that? Right now, I suspect it's going to be the non-bank financials.
Mhm.
Who's financing the non-bank financials? That starts to get a little bit trickier.
Right, that is very difficult, but it probably stops a lot of those loans probably do backstop with the non-banking financial institutions because they don't have any flexibility in financing through other routes. They're holding them effectively.
That's right. So they are holding them and they're stuck with them. And again, this is a lot different than where we were in 2008, where you would collect a lot of subprime loans. And then just because of the enormity of the amount that you had, you figured, well, some of them will be good, some of them will be bad. And I can securitize this out into the market and someone would buy it. That's no longer the case. That's not what is happening right now. So those loans are parked with these subprime, the subprime loans are parked with the non bank financials, and that's where we're gonna see the pressure.
Right, okay, so, switching gears a little bit, there is another, suspicious area in the market right now, which is high yield. Do you have any thoughts on that?
Well, high yield makes complete sense. What does high yield mean? Well, high yield is where your balance sheet isn't in great shape. You're high yield for a reason. You're a little more levered, you have a little more debt, and you're really counting on that cash flow. And investors in high yield are counting on the sustainability of the cash flow of the business to see them through. I think this is an environment where high yield comes under a lot of pressure because even though rates have come down, the concern is the economies are coming down as well, right?
Right,
Is recession looming?
right.
That's what every investor is thinking right now. What do we do with this? And so that's a lot of pressure on high yield. And those companies that are more levered are in a more precarious position as we go into this. And whether it's recession or temporary slowdown because of the coronavirus, the shifting supply chains,
Mhm.
manufacturing inventories, and just timing of production levels, that can put pressure on businesses that, in that case, in high yield, need to produce the cash flow to pay down that debt to make their interest rate payment. That's where those businesses, I think, are really, we're going to see a section of the market that does see pressure.
Okay, I noticed in that list of things that could pressure high yield, you didn't mention the consumer. Was that intentional or
Interesting. I still think, certainly in the US, we are dealing with a very strong consumer. So when you think about the US consumer, they are they have been incredibly resilient and they have had very high confidence levels throughout. And so we've seen them sustain this recovery and it has been on the backs of the US consumer that the US economy has kept inching itself forward and growing. And I think what we're seeing now is still strength in the consumer. I still feel that the consumer is out shopping. We were joking in the office, but what do you do when you're stuck inside and can't go anywhere for 2 weeks? You probably binge watch something online and shop.
right?
So you're using that online connectivity and you are shopping because you can. You also are seeing a huge shift in how consumers spend.
Mhm.
So people like experiences, they like services. They don't necessarily need more things,
Right,
but they like that experiential aspect to it, and we certainly see that with millennials who are not hesitant to spend.
right.
We the misnomer around millennials is we think they spend all their money on avocado toast and do nothing else.
Yeah.
They actually work very hard. They do save, but they do spend on experiences. They're okay with that. And so I think what we're seeing is this shift in changing shopping patterns and habits from the consumer as well, and I think that dovetails into all of this, where again, this disruption could make that shift even more extreme and more visible. I do think the consumer continues to spend.
Yeah, and it is interesting to see how, that shift has occurred in some retail spaces. The retail spaces used to be relatively flat places with signs and colors and things like that. Now they have opening parties with dance crews and
Right.
music and stuff.
Social media, very important, right? Very interactive. It's again back to the experience. Come to the store. You go to the store for the experience.
Mhm.
You go online to buy what you decided you wanted, or when
Right.
you figured out what size you were. Oh, I saw the sweater. It looked really good. I'll get this.
Yeah.
So it's a very, retail is one of the areas where the bricks and mortar have been seeing that pressure for the last multiple years,
Right.
where we've seen that shift in traffic patterns. And the retailers that have done well are the ones who have built up that online presence as well, and
Right.
have learned how to interact with their customers via social media, via that online persona, and being able to complement the bricks and mortar with that.
Okay. So let me roll all this up to an investor. Let's say you have new capital, or let's say you decided now's the time to invest some capital that's been on the sidelines. What does an investor going in now look for?
Oh my gosh. I think the investor going in now is kudos to them because it's tumultuous times,
Hmm.
and good for them for thinking about investing now, because really this is when you should be thinking about it, right? Look to the long term. If someone
Hmm.
had stepped up in 2009 and said, I'm going to invest, they would have done incredibly well.
Yeah.
But the day after they put their money in, they probably would have been feeling a little bit nauseous and said, oh
Right.
my gosh, what did I do?
Right.
So you really have to look to the longer term. There's so much volatility in the short term right now that it's impossible to get clarity and say, here's how things will look a month out. Here's how things will look 2 months out. But investing longer term, I think it's pretty clear to see that we do have, a strong consumer base. We have a growing population that still is going to want to spend.
Hmm.
I think we have a global economy that, as we're seeing from the implications of the coronavirus, we're globally very tied together.
Oh, yes.
And so we do have a growing global economy, and the globe around everyone around the world still wants to spend. They
Right.
still want to improve their standard of life. They want to include things, material things, experiences in their day to day existence. And so I think that you have to look at that longer term and say the world is not going to stop turning.
Right.
It will keep going and this will move on, but you don't have any visibility for the next 6 months. I think investors coming into the market need to understand you're not going to time the absolute bottom.
Right.
Don't expect to.
Right.
But if you can look at this a year out, is the coronavirus still going to be hampering the world a year from now?
Right.
Probably not.
Right.
We'll come to some resolution that will have shifted through the economy and the population, and it will have passed.
Right.
I think if we look a year out, are we going to have some sort of resolution as it comes to the price of oil and global conflict? Probably,
Maybe.
because maybe
Yeah.
there might be some new
Yeah.
version of the conflict,
Right.
but none of the OPEC countries, none of the oil producing countries can afford this to be in free fall, complete
Right.
turmoil for another year.
Right.
There will be stages where they come to some sort of resolution and it at least plateaus out, where you have a level playing field and you can try to figure out what's going on.
Yeah.
So I do think that investors who have that longer term time horizon can recognize that this is where, this is still a good time. This is where they should be thinking about investing and committing capital. It's a great time to have cash because obviously if you have cash, you now is the cash is king at this very moment.
Right.
And you're in the catbird seat where you can then look to deploy as you see fit. I think what's interesting here for investors, particularly investors in the equity markets, is when we look at this and we look at the multiple expansion that happened in equities, it was because there was no other place to go.
Right.
Companies showed reasonable growth. It wasn't outstanding growth. And yet we saw a lot of appreciation in the equity markets because of multiple expansion,
Right.
because people were willing to pay more for those assets because they couldn't find that growth anywhere else.
Right.
We're in a macro situation that is forcing interest rates lower.
Right.
And with that, remember that, while we sit here in the US and look at a positive, number for any point on the yield curve, that's not the case for most other places.
Right.
And so we are still in a great position on that. And that's why when you see global scare, as we are right now, we talked about the 10-year briefly and the rate on the 10-year.
Yep.
The 10-year is an impact of global sentiment.
Right.
And when you see global fear, it floods into the 10-year. It's very tough for the Fed, who's trying to manage interest rates, because the 10-year and the long end of the curve is completely disconnected from
From
the front end, that
right,
Fed funds rate, and the short end of the curve. They
right,
are not any way related anymore. They're completely separate. And so when you see global fear, you see the long end of the curve come down in
right,
terms of yield because people are seeking safety. And relatively speaking, they feel that they're moving into one of the safer currencies, one of the safer economies, and it's still a positive rate,
right,
right? You can't get that if you're trying to do this in Switzerland. So
right,
so it's that's what's relevant here is how low those rates are. When you look at how low rates are, we almost are, I think, forced to then acknowledge where can I find a return and what's the free cash flow yield
right,
on companies. Because
right.
if I can invest as a shareholder in a company that still has positive free cash flow yield, I'm doing better than taking negative interest rate return.
Right. I just want to inflate that for 1 second because very often in times of difficulty, some of the stuff we all learned in CFA level one comes back, right? This podcast is called Compound Insights because I believe in the power of compounding. You just mentioned FCF. That is like CFA level one, week two, right?
Exactly. It's critical, and we forget about that, but effectively, you're saying, "I'm weighing out the risk of investing in a business versus holding cash in the
Right.
bank,
Right.
and then I'm getting paid for that." Effectively, even if it's not paid in a dividend, that free cash flow goes to the shareholder, and it compounds the value of the business. So
Right.
you're weighing that out versus the negative interest rate on your sure thing holding money in government treasuries that, again, if it's negative, you know the cost that you're paying for that. Are you willing to make that trade-off? And so as interest rates stay low, then we're back to where we started as we began this recovery with global interest rates falling. I need a return somewhere. Where do I go? On a relative basis, I still have very few places that can give me a positive return. And publicly traded companies are one of those places that can deliver positive returns.
Great. Well, thank you, Susan. I think we'll leave it there. I think everyone heard that globalization is going to keep going on and do your homework. So
Exactly.
thanks for being here.
Thank you.
So, and thank you all for listening in to Compound Insights by CFA Society New York. You can find our other episodes on the podcast app of your choice or our website, cfany.org.